Kathleen is the great expert on IPOs here, and despite a roller coaster ride in 2019, the IPO investors made money. And they're starting off 2020 in the green as well. I don't mean the guys who are selling the stuff. I mean you, the viewers, who are buying the stuff. The Renaissance Capital IPO ETF, Kathleen controls this. The ticker's IPO, holds a basket of 60 or so of the most recent large IPOs. It's at an historic high. Look at this outperformance with the S&P 500. That's the IPO ETF in the last year, and the S&P on the bottom there, it's up nearly 10% versus a 3% gain for the S&P 500. This is since the start of the year, I'm sorry. But you see that outperformance. We had filings yesterday from Reynolds Consumer. Talk about my childhood. This is the maker of Reynolds Wrap and Hefty trash bags. Love both of them. And OneMedical, which runs health clinics. So what's next? Kathleen, you're the expert. Why is your IPO ETF up 10%?
Well, the beauty of an ETF with IPOs is it takes the emotion out of investing in these newly public companies. And the way it's designed is to make sure that they're weighted based on tradable float. So in the case of Uber, where we've had over a 20% gain, and that's one of the largest constituents, we waited to really get the full position. It came on the rebalance after the lockup release happened with Uber.
This was in November.
In November, the lockup release, and then Wall Street analysts...
And you rebalanced when? Middle of December?
We did. Like all other ETFs, it's a quarterly rebalance.
So I just want to point out here, look at these, she owns all these stocks, put that back up. Beyond Meat's up 71%. Smile Direct's up 51%, but more importantly, Uber and Lyft up 20%. This is since the start of the year. Now, Uber and Lyft together are 15% of the IPO ETF. So when this is the answer to my question. When these two stocks move like that,
right, and
the thing is going to move.
Also helped by a lot of bottom fishing that happened after the third quarter when the market dropped. And then our product owns a lot of enterprise software companies that are subscription models, and those have been darlings in the overall market.
Can you give us 20 seconds? We got Reynolds Consumer coming. I mean, obviously big consumer company. OneMedical, this is a venture capital backed, essentially a tech solution to how do I get to see a doctor fast story.
Right.
Can you give us 20 seconds on each one of them? What are you guys saying?
OneMedical you have to look at because it's one of the few companies that has accelerating revenue growth. And with a new company, to see revenue growth accelerate means a lot of eyes are going to be on
People are going to love that.
Healthcare clinic company.
Is it profitable?
No, it's not profitable, but the idea is that the fast revenue growth will make it. What is really profitable was Reynolds Consumer, but it's not really growing. So you got a very strong brand name. It's going to be a big IPO.
So you got the opposite situation, profitable but not really growing versus growing but not really profitable.
The benefits of diversification that you can get with the Todd wrapper.
So when the market gets jittery, we'll be happy to own Reynolds Consumer. When the market's like this, we'll own OneMedical. And the thing is that this year, given the performance of the ETF, it tells you about how investors feel about the IPO market. So it means that we're going to start out this year with investors that are interested in the new companies.
And that helps the new companies, right, that are coming. I mean, sentiment is strong, so it's a psychological thing.
Psychological. So you can, if you're a company wanting to go public, you'd look at the index. And then also, this is the year where companies are going to rush to get out. It's an election year. Our data shows that the most activity will happen before that. It'll be a little slower in the third quarter.
I want to get to that in a minute, but I want to get your thoughts on what's coming up now, because we have Airbnb is sitting out there.
Airbnb is the big one, most highly valued private company out there. Going to try to do a direct listing.
You think it might be 30 billion? What's the?
Well, 31 billion is the last private valuation.
Yeah, which we found out doesn't necessarily mean a lot.
It doesn't, and I think that the IPO market is a much more rational place than the private market. So we'll have to see.
Okay, now we have this whole debate about direct listings here. I know you have some opinions about this. I think it's highly likely Airbnb will use a direct listing, meaning that they're not going to go through a traditional underwriter. What is your thoughts on that?
Well, they're wanting to use it because the venture backers and the company, they want to get the highest price possible and sell as many shares as they can on the first day of trading. Yeah. Well, we don't think that formula works too well for
the buyers.
Investors. Yeah. And if you look at the two that have been done already, Spotify,
hasn't gone so
and
great.
Slack.
Yeah.
They have not traded that well.
What's the problem? They don't have a lockup period. Is there evidence that a lockup period does actually help investors?
Well, let's think about it for a minute. If you have to wait 180 days and you're an insider to sell, and the company has to report about 2 quarters of results during that time, that might give you confidence that you can trust this company.
So you think that actually makes a difference, the fact?
The lockup is meant to have the company, the price discovery happen before insiders sell. And the earnings, the results that are reported every quarter matter a lot. So that lockup is important to investors. Where they should be focusing is IPOs are expensive. The growth spread's a lot. Just negotiate a lower growth spread.
So it seems like there's an interesting, a simple compromise here. If investors are concerned about a lockup and Airbnb is considering, why doesn't the company itself announce a self-imposed lockup and everybody else can sell when they want? Some of the employees can sell if they want. Isn't there a middle ground that they can create a sort of hybrid situation? I
think the regular IPO market is working quite fine, thank you. Just look at the returns on the IPOs that have been done over the last several years. The existing IPO market is not broken from an investor standpoint, it's broken from the issuer standpoint. So it's because the issuers, the private companies, have been overvalued privately, and the public market. So
you're saying there's a bit of a con game going on here. They want to be able to dump the shares on the public really fast and not have to be subjected to the public market valuations.
Natural. It's natural.
Yeah, but the public market would devalue it. They're not stupid. Just because Goldman Sachs is not underwriting it, if the thing goes public and it's sitting out here right behind me, people can evaluate it. I mean, am I wrong? I mean, is a direct listing really going to change the valuation of a company long term?
Accessibility is going to be the factor. I think if you can buy it and you can sell it and it's liquid, accessibility is going to be the differentiator.
But an investor could use the ETF to be able to get exposure to that without having to necessarily work with their broker if it was through that. So that's, again, using the IPO ETF as an opportunity.
The marketplace has changed. We were talking about 20 years ago when individual investors were really active in the IPO market. I mean, I'd be very popular at cocktail parties back then because I knew all the IPO. Now, individual investors are not active in the IPO market. They and their financial advisors are indexing, they're asset allocating. So the market is, the existing public market is filled with a lot of pros who aren't wanting to pay up for the price.
But that's good news. It keeps the lid on valuation.
It keeps the lid. I think that's why the market's been fairly rational compared to what it was in 1999.
By the way, Mark Cuban was just on our air talking about the difference between 1999 and 2019. Of course, 1999 was the top of the internet bubble. I remember I was here when this happened. Netscape went public in August of '95, and CNBC's ratings started going through the roof on when the internet stuff.
We used to say add.com to the end of any name, and it would automatically be oversubscribed.
So, but this is not 1999, right? Do you agree with that? This is not 1999.
Well, I think I'm
talking about stupid valuations and no possibility of earnings at all for any of this
I think that WeWork is an example of why we're not yet at 1999 because
WeWork would have happened in 99.
We do get the irrational exuberance. There's no doubt all markets get it.
Yeah.
But the fact that the IPO market rejected WeWork tells you something about the sentiment and the knowledge of investors in the marketplace saying, wait a minute, I already saw a couple that didn't work, and I believe that point.
WeWork would have happened in 99.
In 99.
WeWork would have gone public in 99 at that valuation and gotten destroyed in 2000 or 2020. Before I let you go, you touched on this before. Your thought is that the IPO market this year is going to be very front-end loaded because of the presidential cycle, which is very well studied already and how IPOs do in presidential. And they tend to be, the first 6 months tend to be where most of the activity is.
Yes,
the third quarter that tends to slow down dramatically going into the presidential election, and then after the election they try to pick up the stuff that hasn't. Do you think this pattern will continue?
We do, unless it's highly certain what the outcome of the election will be, and I don't think we're there yet. And I feel that because of that, and because there's so many private companies that have been private so long, we're going to see some really big companies tap the IPO market in the first half.
Can you name something that I didn't put in there? Casper is supposed to, we're maybe in the next couple of weeks?
Casper's going to
This is a mattress company.
That's the mattress company. It's still a small IPO. But we've got, as we mentioned, Airbnb.
But these direct-to-consumer IPOs have done, You know, it's been tough, direct to consumer, right?
It's been tough. They have to show they actually have a model. And the problem with direct to consumer is it's very competitive. I mean, there's a lot of other mattress companies out there.
My friend over at NYU, Scott Galloway, did a report essentially saying Casper should, you know, lucky if they sell themselves before the IPO, because it'll be rough with them as public. He tends to be, you know, very blunt on these matters, but
many companies go through a dual track process. It doesn't surprise me that that would be what their strategy would be.
Anything I haven't mentioned here that you think could be a surprise in the first half of the year? Any company that?
Well, there's going to be, the private equity category has huge companies that are lined up to go, and I think one worth paying attention to is PPD. It's a contract research organization for biotech, so it's a safe way to play biotechs because they do all the research studies for the biotech industry.
And when will that come?
We think it'll set terms within the next week, so that would be in the next couple weeks.
And you like it because it's a safe way to play biotech generically? It's
a 25% top line grower. It's a profitable company. It's got a very strong business. We think that there'll be others like this.
PPD. Thank you very much. That's a good tip. I'm not aware of that company. I'll keep an eye on that.